Alright, what's up, good people? What it do? This is Taylor with your weekly Watchlist video for the week of September 26th. So I hope you're all doing well and hope you've all recovered from a bit of a wild Friday there. So that's how it works, huh, guys? I go get married on Friday, and y'all break the market on me. So yeah, big day for me on Friday. A couple pictures here. Your boy got married. So there's me and the beautiful bride. Beautiful venue. We had the wedding in Boston. Friends, family, the whole nine. Definitely the best night of my life. So, one for the books, and she's a beauty. So, a couple pictures here. There's the family. There's the fellas. Some of you should know that guy. Young Chandler. And, yeah. A big night in the books. So now I got to get back to work and pay for that wedding. So, we'll jump in here, guys. But I hope you're having a good weekend. And, yeah, the S&Ps and the Qs, I'd say we got close enough for government work on Friday to the June lows. So now the big question, of course, is do the June lows hold? And in my opinion, they do not. They do not. So the notes of the week ahead here. For now, everything currently implies the June lows will not hold. We're a little bit extended, a little bit oversold. So maybe we get a decent bounce this week. I, for one, would like a bounce because I want to short the crap out of it. So for now, I don't think the June lows will hold. Being that we are a bit stretched, if we could bounce, I think you want to short the crap out of that bounce. So personally, I'm looking for some November call credit spreads on the S&Ps, Amazon, Apple, and maybe a little bit of Snowflake. So we'll take a look at a few of those here. But yeah, guys, we got close enough for government work there on Friday. So a few things here. As far as the problems, and we've talked about the problems for the last, a few months here on the channel. One of the bigger problems here for the market is the dollar. And the dollar is still pumping that good booga sugar. Monster, right? Monster. Such a monster, he made this huge rip. The daily squeeze hasn't even fired to the upside yet. Not to say it has to, but yeah, this thing's a total nut job here. On the big 3 indicator, we have buy signals on every time frame. Pretty bullish in my book. So, the only thing you would want to see here from the dollar as far as I say it out loud, I'm not too sure. If we're going to get a bounce in the market, we need a dip in the dollar. Now, technically, if you want to look at the dollar like you would look at a stock, we're a little bit overbought here. So there's always that growing probability. We could pull back towards that 21 EMA. For what it's worth, I kind of doubt it, at least for now. So maybe, if anything, a little dipperoo here in the dollar. Probably good for the S&Ps and the Qs as far as trying to get a bounce. Of course, bigger picture. The dollar stops being a problem, I think, under that daily 50 SMA. So I think for now this looks bullish as hell. Any little dip here, you might get a pop in your market, but bigger picture, this has been and is still one of the most bullish trends out there. A problem for the market. Then another problem here, of course, is HYG. And as far as HYG goes, we get a brand new low here on Friday. If this can't boogie back above previous support, which would be $73, it is problematic. So, bigger picture for HYG to kind of, fully shift the structure and clean up all the problems here. You need this back above the 21, you need it back above the 50, so I think we don't see that for a while. In the short term, any bounce here in HYG, you should get a bounce in the S&Ps and the Qs. So, of course, if HYG can't even get back above 73, I think you see the markets struggle to hold there at the June lows. So the dollar's a problem, HYG is a problem. And the volatility index, guys, you got a little flush there into the close. So the market was able to get a pretty decent bounce going. I think the VIX has got plenty more upside here. Eventually I think we're going to get through 40. But I do think for the week ahead, if you don't get the VIX quickly under $27, if the VIX doesn't quickly take a bit of a chill pill there, if we can't get the VIX popping a few downers, this kind of looks poised for a move back towards 34, 35, and again a little bit higher. So for now, the VIX is looking bullish. We got big 3 buy signals on the 2-hour, 1-hour, 30-minute time frame. If you're looking for a pop in the market to short like I am, I want to see VIX under 27. If it keeps hanging out up here at 27, 28, I'm a bit more inclined to think she wants to rip. So as always, guys, keep an eye on the dollar, which for now is super bullish. Keep an eye on HYG, which for now looks a bit like death, and of course keep an eye on the VIX. That should help you, get a better sense of, do we just continue to flush from here, or can we get a shortable bounce? Now, as far as a few bigger picture things, maybe an interesting perspective. Of course, this year has been really bearish. So if you look at the old S&Ps here back in December, we've obviously had a pretty good pullback. 480 to 365. Nothing to sneeze at. The question that I have, because as traders, we kind of sit through this, every day. I think some of us every hour of every day. We're feeling it. We're living it. We're breathing it. All that good stuff. Again, I don't want to discredit this pullback. It's definitely been a pretty good pullback, but bigger picture, you look at a few monthly charts, you look at a few weekly charts, I do think it raises an interesting question. Has the downtrend even really started? And I kind of think no. So a few observations here. On the monthly chart of the S&Ps, and we'll look at the SPX here. This monthly chart is not even close to downtrend. Technically, the monthly chart is still caught up in chop. Now, what's interesting is, and we talked about this a few weeks ago, we have the first negative histogram. And I'll pull up the SPY. I think it's a little bit further down the road here. I'm wrong. We're 1 month in. Regardless, the S&Ps and the QQQ, you have the first negative histogram on the squeeze indicator since, drumroll, 2008. And based on what they tell me, 2008, you had a bit of a downtrend going. So I think that's really interesting where, again, that pullback from 480 to where we are right now, pretty good flush, no doubt about it. As far as trend, structure, momentum, we're not quite in a monthly downtrend just yet. Technically, we're not even really just close. To get in a monthly downtrend, we'd have to break the monthly 50. Basically, you'd want to see that monthly squeeze fire to the downside. And then I think eventually you want to see that negative moving average cross with the 21 EMA under the 50. That gets you into downtrend. So even though we've gone from 480 to 370-ish, that's not a monthly downtrend. First negative histogram since 2008 kind of leads me to believe if the market doesn't find a bottom relatively soon, momentum continues to shift here in the favor of the bear skis. That could all start to unwind a bit more. Then we jump over here to the weekly chart. Now, the weekly chart, you've got properties of a downtrend. You're trading under your 21, you're trading under your 50, and you've got that negative moving average cross. Properties of a downtrend, but from a bigger picture perspective, here's kind of your first good flush, right? That kind of cracks the structure. You're under your 50, you're under the 21, you get that negative cross. Here's kind of your first bear market rally. Takes you back towards your falling weekly 50, and we get stuffed. Now we find ourselves sitting here in a fresh weekly squeeze, which still hasn't even fired to the downside. So bigger picture, it's been a pretty good ride from 480 to 370. A lot of blood and tears, right? A lot of damage along the way. Bigger picture, you're in a monthly trend that still hasn't technically flipped bearish just yet, and it could. And there's big implications if it does. And from a weekly charts perspective, there's been some pretty big damage, but you're kind of coming out of your first bounce here, and now you're coiled up in a weekly squeeze. And, remember the rule of thumb with squeezes, guys. Once a squeeze fires, we're looking for 8 to 10 bars of momentum. So based on that rule of thumb, if that squeeze can fire short here, you're looking at potentially 2+ months of momentum to the downside. So I think an interesting perspective where, again, as a trader, you kind of feel this whole downtrend every day. We're living it and breathing it. As far as the bigger picture, your trend, your structure, your momentum to bigger time frames, it does kind of feel like the party is just getting started here. So a few bigger picture things, but from my point of view, whether we're looking at a monthly chart of the S&Ps, a weekly chart, whether we're looking at the dollar, HYG, the volatility index, everything for now kind of points towards, maybe you get a shortable bounce here, but those June lows probably don't hold. And if you go sector to sector, guys, it's market wide. Right? So as far as any bullish ideas, I got none for y'all this weekend. XLK's at the June lows. The semiconductors actually made a new low on Friday. The industrials, fresh low on Friday. The utilities, the Utes, they look like a good short. Right? You're on the verge here of that negative moving average cross. Again, I'm probably going to short the S&Ps or Amazon, but the utilities, they look like a short, so I'm not getting long there. Energy, shit the bed on Friday. Healthcare, XLV, that looks like a short. Everything looks like it wants lower prices. Even the solar sector. Even TAN broke down. That looks like a short. So that's where we are. At least for me as a swing trader, trend, structure, momentum from a weekly chart down to a 5-minute chart, it all says short the bounce. So that's a game plan. Now as far as my picks here, numero uno, I would like to sell a call credit spread on the SPX. And for all these trade ideas, guys, we're thinking November, December expiration. Most importantly, we want to put these shorts on after a bounce. The bounce gives you a better risk reward, better entries, better exits, just makes your life a lot easier. So, numero uno would be SPX. And I'm not going to go into too much detail on the exact spread. We'll do that as we get a little bit closer, meaning if we actually get a bounce here. But, the game plan overall for SPX, on a good rip, on a good rally. I don't like that being orange. Hold on. There we go. November, December expiration, 4,000 strike call credit spreads. And mind you, I'm looking for put debit spreads. We're going to buy some puts, but the topic of discussion tonight is call credit spreads. So, on a good rally, SPX, November, December expiration, 4,000 strike call credit spreads. On a good rally, we should be able to lock in a pretty good risk reward, and then we can sit back and watch it all unfold. So that's one idea. And then the second idea here would be Amazon. And obviously Amazon is such a huge component of the market. These are kind of the same trade ideas, meaning if the S&Ps continue to just puke, October bloodbath, November bloodbath, December, Amazon's going to be trading much lower, and vice versa. What I do like about Amazon here, we got a good 13-14% until we're back down there at the June lows. Never mind a new low. So I do want to short Amazon here for a move into about $100. Then we'll take it from there. But hanging out down here at minus 3 ATR on the daily chart, I want to short the bad boy after a bit of a rally. So on a bounce, 125 strike call credit spreads for November or December expiration. Then we got Apple here, and I think the most important stock in the market. 150 breaks. Like everything, I think you see Amazon, or Apple rather, back down towards the June lows. So what I would like, again, on a bit of a bounce here, November, December expiration, 160 strike call credit spreads. And depending on the bounce, here's the goal, guys. I'm not always too concerned about the risk versus reward on the spread in terms of max profit versus max loss. What I'm a bit more concerned with is, can I get a good bounce, and can I sell that call credit spread at a spot that'll offer me a good risk versus reward between my targets? In other words, I'm not too concerned if the max loss, max profit on the spread is, risk $5,000 for $2,500. What I'm a lot more concerned with is, where do I want to take the entry? Where's my line in the sand, right? Where am I wrong? And where's my profit target? So for conversation's sake on Apple, let's just say my line in the sand is 165. So I want to exit any short position or flip bullish on a move back above 165. Let's say my target is a move down to 130. Looking for a flush. There's my line in the sand. There's my target. And now my concern in terms of where do I take my entry? How much time till expiration? What strike selection? I make all those decisions based on the risk versus reward between those two levels. To me, it's a crappy trade if on a move up to 165, I'm going to lose $5,000. And on a move into my target, I'm going to make $5,000. Right? It's 1-to-1. I want to be in a position where when I'm correct, when the trade works, I'm making more than I'm losing when the trade goes against me. Then you can fully maximize a good 70% win rate. So ideally, I want to risk $2,500 on a move towards 165 to make $5,000 plus on a move down to my 130 target. So these are the things you want to do on the weekend, right? Check your indicators, check the structure of the charts, figure out your target, figure out your line in the sand, where you either want to exit the trade or flip bullish. Then you can play around in the Analyze tab, right? You can put together spreads, you can do debit spreads, credit spreads. Play around in that Analyze tab and get a true sense of, okay, if I can get that December expiration spread at $4 of credit, how much am I risking on a move into my exit versus how much can I make on a move into my target? Then you got a sense of whether or not it's a good trade. You want to make sure your losses smaller than the winners. So Apple, November, December expiration, 160 strike call credit spreads. So we got the S&Ps. And mind you, the S&Ps and the Qs kind of go hand in hand. We got Amazon, we got Apple, and then kind of a rando here, Snowflake. Right. My thinking right now, guys, is everything goes down towards the June lows. And I think Snowflake here has got a lot of room. Currently trading around 170 with the lows back down there at 110. So if the snow melts here, down towards 110, I want to catch a little bit of that. So, nowhere near as oversold as the rest of the market. So I'm thinking 190 strike, call credit spreads for November expiration, and admittedly, I don't think you have to really wait for much of a bounce here. Of course, if you get a bounce, you could go up there towards 195, 200. You could push it further out the money, or you could just wait for a bounce and sell the 190s with an even better risk versus reward. A little bit of relative strength here, but I do think eventually if the market heads where I think it's heading, it's going to take everything with it. So, few ideas for you guys there, but the most important thing is we want to short into bounces, and before we pull the trigger on our shorts, we want to know our exit and we want to know our target. Then we can figure out the option strategy. Buy some puts, in the money, out the money. We can do debit spreads, we can do credit spreads. Pick your spots wisely, and I think for now the wise decision is to be patient, which isn't always the easiest thing, but try to be a bit patient. Wait for a decent bounce here. Smack on a couple of the shorts for November, December expiration, and then sit back and sip some eggnog and let that premium come in. That's a game plan for now, guys. Hope you all found this helpful. If you haven't already, go on ahead and hit the like button and the subscribe button. Really appreciate that. And for those of you in the mastery, I appreciate all your patience over the last couple of weeks here with the wedding planning. But I am back to work tomorrow, a married man with responsibilities. So enjoy the rest of your Sunday, guys. We got the Broncos game here in a little bit, so I'm a bounce. But hope you found this helpful, and I'll see you guys tomorrow morning for pre-market prep here on the channel at 8:45 a.m. Eastern. Hope to see y'all there. Until next time, be good, trade good. Talk to you soon.